What if I told you there's a legal business model where companies collect your money, invest it in the stock market, keep all the profits, and only pay you back if something goes wrong? And what if I told you most people voluntarily sign up for this every single month? That's not a scam, that's insurance. And by the end of this video, you'll understand why it's quietly the most perfectly engineered money machine in human history. And why the man who figured it out became one of the wealthiest humans who ever lived. Let's start with a number that will make your stomach drop. The global insurance market, $8 trillion. Not revenue, value. Bigger than every economy on Earth except the United States and China. One industry, $8 trillion. Built entirely on selling people a promise. Here's what's wild. Most people think insurance is a safety net. You pay in. They pay out if something goes wrong. Done. That is not the business. That is the cover story. The real business has two engines. Most people only know about one. Engine 1 is obvious. Premiums minus claims equals profit. You collect $100 from 1,000 customers. 30 of them file claims averaging $500. You pay out $15,000 and pocket the rest. Simple. Insurance companies hire armies of mathematicians called actuaries, whose only job is calculating exactly how likely you are to die, crash, flood, or burn, and pricing your premium just high enough that they win on average, every time. You think you're buying peace of mind. You're actually entering a statistical experiment where the house always wins in aggregate. But that's engine 1. Engine 2 is where this gets genuinely strange. Stay with me. Because this next part is what turned a small textile company from Omaha into one of the 10 greatest fortunes in human history. Here's the secret. When you pay your car insurance premium in January, your insurer doesn't need that money yet. They might not pay a claim for 6 months, 2 years, or ever. That gap between collecting your premium and potentially paying your claim is a pool of money they can invest freely. Warren Buffett called it the float. His exact words, "This collect now, pay later model leaves us holding large sums, money we call float, that will eventually go to others. Meanwhile, we get to invest this float for Berkshire's benefit." Here's the number that should stop you cold. At the end of 2024, Berkshire Hathaway's float, the money sitting between collected premiums and unpaid future claims, totaled $171 billion. They are holding $171 billion of other people's money, investing it freely, keeping the returns, and on top of that, making underwriting profit on the premiums themselves. Do the math on what $171 billion generates at even a modest 5% annual return. $8.5 billion a year. $23 million a day. Almost $1 million every single hour. From money that isn't technically even theirs yet. That is the machine. Wait, so they get paid to borrow from us? Essentially, yes. The float is cost-free leverage. And that single insight, that the real product isn't insurance, it's the time between premium and claim, is what separates billionaires from business owners. Now, if this is a guaranteed money machine, why do these companies ever blow up? The math is bulletproof. The people running the math are not. Open this loop in your mind. What is the single biggest insurance failure in human history? It wasn't a hurricane. It wasn't a pandemic. It was one small office inside a company that had over $1 trillion in assets, insuring 85% of the Fortune 500. We'll get there. But first, the math. There's a number every insurer obsesses over: the combined ratio. Take every dollar paid in claims, add every dollar spent running the company, divide by total premiums collected. Below 100%, you're profitable. Above 100%, you're bleeding out. A well-run insurer targets 95 to 98%. That sounds fine, until a catastrophe hits. After Hurricane Katrina, some insurers saw combined ratios spike past 130% in a single year. Companies that had priced their risk for a normal world got destroyed by a world that kept having abnormal years. The companies that survive aren't the ones that got lucky. They're the ones that stayed boring when everyone else got greedy. Now, that story I promised. 2007, AIG is the world's largest insurance company. Over $1 trillion in assets, operations in 130 countries. Then, a small division inside AIG, AIG Financial Products, starts selling financial insurance on mortgage-backed securities, guaranteeing that if the US housing market collapsed, they'd cover the losses. The rest of AIG was fine, running perfectly, doing exactly what insurance is supposed to do. But this one division had written so many guarantees on toxic assets that when the housing market buckled in 2008, AIG lost $99.2 billion in a single year. The Federal Reserve stepped in with an emergency loan of $85 billion overnight. The total government bailout eventually reached $182 billion, the largest corporate rescue in American history. Here's the brutal lesson. AIG didn't fail because insurance is a bad business. AIG failed because someone inside an insurance company forgot they were running an insurance company. The machine works perfectly until someone reaches inside and breaks it. Now let's talk about what it looks like when nobody breaks it. Small regional insurer. Starting capital, $10 million. Auto and home policies for a mid-sized city. Annual premiums, $8 million. Claims run at 65%. They pay out $5.2 million. Operating expenses eat 25%. Combined ratio, 90%. Underwriting profit, $800,000. Float invested in short-term bonds at 4.5% adds another $200,000. Total annual profit, roughly $1 million every year, in any economy, in any recession. Boring? Yes. Bulletproof? Also yes. Now scale that to the Berkshire model. Float of $171 billion. Not invested in bonds. Invested in Coca-Cola, Apple, Bank of America, and private companies. The float is free leverage. The insurance operations themselves run at an underwriting profit, meaning Berkshire gets paid to hold the float, not the other way around. The result, one of the 10 largest fortunes in human history, built not on tech disruption, not on oil wells, not on social media, but on selling people car insurance and being extraordinarily patient with the math. Lloyd's of London was founded in 1688 in a coffee shop by merchants who wanted to share shipping risk. 338 years later, it still operates on the same fundamental principle. You pool risk, you price it correctly, you invest the float sensibly while you wait. You don't get greedy, you don't wander outside your lane. Berkshire Hathaway's book value has grown 20% per year since 1965, double the S&P 500's return over the same period. Not because Buffett was the world's greatest stock picker, because he built a structure where he got paid to borrow $171 billion for free, and then invested it better than almost anyone in history. So here's the entire model in one sentence. Collect premiums, price them right, sit on the float, invest it well, don't blow up, repeat for 100 years. That's it. That's the machine. Share this with someone who still thinks insurance is just a bill they pay every month. And subscribe, because next, we're going into the business that makes insurance look simple.